If you own Nvidia stock, an S&P 500 index fund, or a tech-heavy 401k, this matters. Most shareholders assume Nvidia's published earnings already reflect the true cost of running the world's largest AI inference and training infrastructure. They don't. Research into Nvidia's FY 2024 10K and Q4 2024 earnings call reveals a critical gap. Roughly $10 billion annually in internal compute costs tied to GPU development, AI model training, and data center build-out sits in the capital expenditure bucket, not operating expenses. That's the first problem, under current SEC accounting rules. That means the profit hit is deferred 3-7 years. When it accelerates, Nvidia's net income could compress by 8-15%, which translates to $4 billion to $5 billion annually in earnings erosion. On a $500K portfolio position, that's $75K, $200K in foregone 10-year returns. And if you're banking on Nvidia reaching your retirement goals in 2034, that gap gets bigger every single year you wait to adjust. Here's the first piece. Nvidia's capex spending jumped from $2 billion in FY 2023 to $7 billion in FY 2024, a 67% year-over-year increase. That's not a typo. $5 billion in new spending in 1 year. Much of that is tied to internal compute infrastructure, the GPU clusters Nvidia uses to train its own AI models, the data centers it operates for internal R&D, the inference farms running behind the scenes. But here's the critical signal. Nvidia's operating expense line hasn't moved proportionally. R&D expense grew only 12%, $2B to $6B. How does capex explode 67% while OPEX grows 12%? The company is capitalizing compute costs rather than expensing them immediately, which defers the earnings hit into future periods. It's legal, it's standard, but it's invisible to most retail investors. Second, the accounting rule that enables this deferral is ASC 350 intangible assets and ASC 360 property, plant, and equipment. When Nvidia builds internal AI infrastructure, GPU clusters, data centers, AI model training farms, it can capitalize those as long-term assets and depreciate them over 3-7 years, rather than expense them upfront. A $10 billion investment today hits earnings gradually. Not immediately. It looks like growth. It feels like efficiency. It's actually accounting camouflage. But here's where it gets real. If the SEC's 2024-2025 guidance on AI company expense recognition tightens, and early signals from the SEC's Division of Corporate Finance suggest it will, Nvidia could face accelerated amortization or restatements that crater earnings in a single quarter. The delta is stark. Nvidia's current P/E multiple around 52-58x forward earnings, prices in long-term earnings growth of 25-30% annually. That's the consensus. But if compute costs are categorized from capex to OPEX faster than expected, say over 2-3 years instead of 5-7 years, that growth compresses to 15-18%. Think about what that means. On a $500K position at current valuation, a 5-turn P/E compression translates to $75K, $200K in lost value. For someone planning to retire in 2034, that could mean $50K, $200K less annual retirement income, depending on your 4% withdrawal rule. That's not abstract. That's your beach house. That's your grandkids' college fund. Here's what to watch. Nvidia's next 2 earnings calls, Q4 2024 and Q1 2025, will include updated capex guidance and depreciation schedules. If management raises depreciation expense by even $1-2 billion, or discloses any SEC inquiry into compute cost classification, volatility will spike immediately. That's your signal to rebalance before the broader market reprices the stock. Don't wait, the window closes fast. For high-income earners, the tax angle matters too. If Nvidia compresses 8-15% due to accounting reclassification, your long-term capital gains picture changes completely. A $500K position held 5+ years that you assumed would grow to $750K might only hit $680K. That difference, $70K, affects your tax filing bracket, your Medicare premiums, and your retirement income planning. The SEC's scrutiny intensifies in Q1 2025, so decisions made now matter. Whether to hold in taxable VS, retirement accounts, whether to trim the position, whether to harvest losses, these moves could save you thousands in taxes when the revaluation hits. Bottom line, Nvidia's earnings aren't lying, but they're incomplete. The true cost burden will surface this quarter. Position accordingly. In strategy, the quiet observer wins.